So the question says that Bermuda Limited presented the following financial statements for the years ended 30th of June 2021 and 30th of June 2022. Statement of profit or loss for the year ended. So we are given revenue, cost of sales, we have the gross profit, we have the gain on financial assets at fair value, we have the investment income, we have other expenses, administration expenses, distribution costs, finance costs, profit before tax, income tax expense, profit after tax for the year. Then we are given the statement of financial position, starting with net current assets, property, intangible assets, then financial assets, through other comprehensive incomes. Then we have current assets, inventory, we have trade receivables, financial assets as fair value, cash and cash equivalents. We have the total assets, equity and liabilities. We have equity, ordinary share capital, share premium, revaluation reserve, financial assets through OCI, other comprehensive income. There's an equity reserve, retained profits. Then we have non-current liabilities, 10% convertible loan stock. We have the current liabilities where we have bank overdraft, trade payables, interest payable, income tax payable, total liabilities, total equity and liabilities. Additional information is that property, plant and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th of June 2022, items of plant and equipment which originally cost shillings 40 million were disposed of, resulting in a loss of shillings 6 million charged in administrative expenses. These items had a net book value of 28 million as at the date of disposal. Depreciation charge for the year ended 30th of June 2022 was shillings 43 million. Shillings 50 million of convertible loan stock was converted to shillings 50 million ordinary share capital at par during the year ended 30th of June 2022. Now, you are required to prepare a statement of cash flow for Bermuda Limited for the year ended 30th of June 2022 as per IS number 7. That is called the statement of cash flows. So that is what you're going to do. That's what you're going to do. So if that is what you're going to do, we will need we'll need 3 columns. So in our solution here, okay. So I increase my font. That good, Alice?
Malim, that's better.
Good. But it's visible now, eh? It's visible, eh? Oh,
Yeah.
Okay. So I was trying to see which columns I could reduce. And I reduce, I'm losing some values, some font. See, if I removed this one, there is much damage, any damage that is done, no damage. So that column did not contain anything. Yeah, that's good. So we are going to start with the name. The company is called Bermuda Limited. Bermuda Limited. We are drawing statement of cash flows. And we are going to use, there are usually two methods. There is what we call the direct method and what we call the indirect method. So if the question is silent, we normally go for the indirect method. It has many marks and is a little bit easier in the exam. Then the statement of cash flow, indirect method, and we are doing for the year ended. For the year ended 30th of June, 2022. 30th of June, 2022. So we can have, we can underline if you wish. Can also underline here. You can also underline this one. Not a must, but if you wish, the breaks no bone. Then here we have details. Then here I'm going to have shillings in millions. And the same case here, shillings in millions. Another line. I can give everything a bottom border. So let me remove the underline there. Nikitaka kufanya urembo kidogo, let me give it a top border. Sorry. So this is just something nice to have. It adds no marks. It adds no marks. So it's just a matter of showing the examiner we are well organized. Good. So if we have something like this, so this one I give it also bottom border, and I remove the other line, remove the other line. Now I want to start by giving us the general format of a cash flow statement so that we remind ourselves, and I believe that will be easier when we come now to working. As you know, a cash flow statement is divided into three sections. We have what we call the operating activities. The operating activities. And under operating activities, we always begin with profit before tax. We always begin with profit before tax. Profit before tax. Then we bring the adjustments. The adjustments. And the adjustments that come, the first one is always depreciation. Not a rule that to be the first one. And depreciation is quickly followed by amortization. Amortization. Then that one is about the intellectual properties. It is quickly followed by impairment. Impairment. Then after impairment, we bring loss on disposal. In case you dispose of, loss on disposal of PPE, in case, and it could also be again on disposal. Then you also bring gain on disposal. Gain on disposal of a subsidiary. Then, in case kuna any investment income, you bring it here. Investment income. Then we have the finance. The finance costs or interest expense. The interest expense. Finance cost or the interest expense. Then we have the share of PAT, the profit after tax in associate. If you have an associate, capital in associate. Then those are the main things that we have in the operating activities. Remember, the operating activities of a company, they define the core business of that company. And there are usually four of them. There is the cost that is incurred so that you get the product or the services that you sell. Then for you to sell, you must do the administration, for you to produce, there must be administration. That's the second one. Then after you have produced, you must distribute to create what we call the price utility, the reach to the customers, and then you sell. That is the revenue. So there are four things. There is the revenue, cost of sales, administration, and distribution expenses. So those are the ones that we bring here. And in case now there is anything else that the business has either lost money or gained money that is not part of those four, we bring them here also. And that's why we are calling them adjustments. I can even make this one to be bold. We call them adjustments. Depending on what they are, we will add or less. Depending on what they are, we will add or less. Then once you have come to there, you get what we call cash flow before working capital. cash flow before working capital changes. Before working capital changes, I could maybe adjust kidogo ifike hapo. Cash flow before working capital changes. This one we can also make it bold. There's no harm. Then we bring the working capital. So the working capital, we have inventory. So the inventory, now this can be increase, or decrease. I think we can, maybe what we'll do, let's see I'm trying to see whether we give everything or we just give as per. Correct. So what I was saying, I'm thinking instead of writing increase or decrease, let's write we have the inventory. We have inventory. We have receivables. We have payables. We have prepayments. And we have accruals. We have accruals. So I'm just giving you the general format. So when we start solving, some of them we shall remove, or you choose to keep or not keep. I'm just trying to remind you. Those are the main items of working capital changes. So we will be saying whether it has increased or it has decreased, and then we judge whether that is an inflow or an outflow. So when you do that, you get a figure we call cash generated. Cash generated from operating activities or from operations. From operations. Cash generated from operations. You can also make it bold. Cash generated from operations. And then from there now, we bring tax paid. Tax paid. When you get the tax paid now, you get the cash from operating activities. From operating activities. Cash from operating activities, that is the main entrance. Cash from operating activities. Okay, then after that now, we come to investing activities. This was about operating activities. So let's come to investing. These are items that touch on investing activities. These are items that touch on the current assets, the fixed assets. And here we will have cash received on disposal. In case we have sold, cash received on disposal of PPE, cash received on disposal. Opposite of that is cash paid to acquire PPE, cash paid to acquire PPE. What else comes quickly is cash received. Cash received on disposal. Disposal of a subsidiary. Subsidiary, net of cash disposed. This one I'll just make it wrap instead of expanding. Then cash paid to acquire a subsidiary. Cash paid to acquire subsidiary, net of cash received. So even this one I can wrap. The next one is investment income. Investment income is there. So with that now, I'll get cash from investing activities. Cash from investing activities. Cash from investing activities. That's a major cash flow. And then finally, we have financing activities. Financing activities. Financing activities. Under that, we have cash received on issue of new ordinary shares. Cash received on issue of new ordinary shares. So even this one I can wrap. The next one is dividends paid to NCI. Dividends paid to NCI, the non-controlling interest. You could also have DV that's paid to HCO, holding company. Then we have the finance cost paid. Finance cost paid. We have loan acquisitions. Loan acquisitions. Then we have loan repayments. Loan repayments. That's something else that you need to check. That will give us now cash flow from financing activities. Cash flow from financing activities. Then we have something else down there called net cash flow. Net cash flow. Then we normally say you add cash and equivalents, cash and cash equivalents, at the beginning or opening, at the beginning, then you'll get cash. So this one I can just come here and modify at the end. Good. So that's the format of the cash flow statement. So what I've given you there is the general format that you should have in mind when you're approaching this question. So we may not have all the items in our question, but I've thought it wise because maybe it's a while for some of us since we did cash flow. We came across a cash flow statement. That we just have that refresher. Yeah. So I believe everyone has finished copying. Let me give ourselves 2 minutes so that we okay. So I believe everyone is done. So we can have our workings here. We can have our workings here. Workings. In case they will be required. So let's now go item by item. So number one, profit before tax. It will be brought here. So you put your cursor there, then press equals. Then we go to the income statement up there. The income statement, here it is. And now you take the profit before tax. Profit before tax is this one. As the profit before tax. So you begin there. When you begin there, you now start looking for these adjustments. Or what we normally recommend, or what myself I normally do, is when you have taken this one, you start going backwards. Checking whether there is an entry that is not one of the 4 items that we mentioned. It is not a cost of sales. It is not a revenue. It is not an administration expense. It is not a distribution expense. All income. Because it could be positive, negative. So let's start with the first one, finance costs. Now, finance costs is not part of the operations, not unless we are told that in this business, they deal with financial services. They give loans. So this is part of their income. But from the look of things, this is not part of their business. So if this is not part of their business, this one is an expense. And when it was included here, it made the profits to go down. So what shall we do with it? We shall return it. We shall add it. We shall add it so that it brings back our profits. So I will come here where I had mentioned about finance cost, this one. And I say equals, I bring this 17. The finance costs should be brought there. Okay. The next item that I find as I go backwards is distribution costs. So for the distribution, we are given 76. And I don't know whether additional information had mentioned anything to do with it. Additional information had mentioned administrative. So now that they are not mentioned, these ones are supposed to be there. So no adjustment regarding these ones. For the administration, they are also supposed to be there, but there is a mention. There is a mention in information 1 that says property, plant and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended, items of plant and equipment which originally cost 40 million were disposed of, resulting in a loss of 6 million charged in the administrative expenses. Charged in the administrative expenses. Okay, yes, I will repeat that. These administrative expenses, they include the 6 million, which is a loss. So we need to remove it. The meaning of that is that the genuine administration costs, the genuine administration cost here should have been 42. Should have been 42. So the 6 should not have been there. So we need to come and return it here. And that is loss on it is loss on disposal. So we had put an item, loss on disposal of PPE. So we just type. It's supposed to be positive. Now, Rachel is asking why I have skipped distribution. It is because I've said in a normal business, we recognize 4 types of activities that we regard as operations. And I'm saying the first one is, or maybe I can start how it goes. You first of all incur the cost of sales. The cost of sales. This will be the cost of producing the goods or the services. And as you do the production, obviously there is what we call the administration. Now, administration, it is what? Administration. It is the coordination of the effort that is supposed to ensure that we produce the product or provide the service. Then, after you produce the product, you must go out there and tell people that I am producing this item. And not only telling them, you need to take it to where they are. That is called part of this, it's called distribution. And then after you have taken to the product or the service to where the people are, you receive money from them, and that money is called revenue. So these are the 4 main activities that we refer to as operations. Any business, it will be involved in this. They will be involved in this. And this distribution, you see, like now, Chacham is not involved so much in distribution, but we are involved in selling. Actually, you find in most cases, they talk of selling and distribution cost. Selling are the expenses you incur to create awareness. Like now, the way you knew me, most likely I had done an advert. And even if you never saw my advert, maybe someone directed you. So that is part of my distribution. Any business will have this. So these ones are the ones that should appear in this part here. Anything else that has come in here is a positive, that is an income, or a negative, that should be adjusted. So I don't know whether, Rachel, that is now clear.
Yes, it's very clear.
So we were looking at these expenses going bottom up. So tumemalizana na finance, tumemalizana na naitwa nani, distribution, tumemalizana na administration. Haya, tunasonga tu investment income. Now this investment income, it is an income that is not part of our normal business. It's not part of our day-to-day activities. And therefore, now that they have put it here, we need to come and less it. So as we bring it here, the investment income, you say equals, na wilete ikiwa negative. Wilete ikiwa negative because when it was brought here, it made the profits to go up. It made the profits to go up. Sasa tunataka kuitoa. Actually, it should be part of investments. So you can even bring it down here. I hope we have put it part of investments here. This one. You can bring it. Now that tumeitoa hapo, you can bring it here. Equals. You just take these 6. That's where it belongs. Okay. Haya. Gain on financial assets at fair value. Gain on financial assets at fair value. Now this one should not be here. We are not in the business of revaluing. So that should be also a reduction. So let's look at whether we captured that. Gain on so we did not put gain. So we have two options. We can add another line here. Let's add another line instead of deleting what we had put. So we can call it gain on financial assets at fair value. At fair value. So we come and say equals. Now that was a gain. So tunaitoa. So itaingia ikiwa negative. This one. Itaingia hapo ikiwa negative. Hapo ikiwa negative. Haya. Then tunasonga tu. The next item we find is gross profit, then cost of sales. Now, cost of sales and revenues, they are part of this. So those ones, no adjustments. Those ones, no adjustments. So the next thing now we need to do is to come and check. According to our format, we had mentioned depreciation. So let's see whether it is mentioned. Depreciation was mentioned here in information 2. So depreciation charge for the year, it is 43. So that depreciation should be added back, is an non-cash item. Remember, when we are doing the adjustments, we remove anything that is not part of operations. And we also remove anything that is non-cash. So the non-cash, mostly it is about the depreciation or the provision for doubtful debts. So I was saying non-cash, we have the depreciation and the provision for doubtful debts. Depending on whether it is an increase or a decrease, as you know from FR, it can either be a gain or a loss. So for depreciation here, the charge is an expense, so we are supposed to add it back. So kuja hapa you type, because we have nowhere to pick it from. Amortization and impairment. Now, amortization, you know, it deals with the intangible assets, and impairment is about goodwill. So the question has not mentioned goodwill, but the question has mentioned to us intangible assets. So what you do, you come and look at the intangible assets here. You come and look at the intangible assets in the statement of financial position and find that in the year 2021, we had 50. In the year 2022, we had 40. We had 40. So there are two ways of arriving at that. There are two ways. First of all, you can see this one is a decrease because tumetoka 50 tukaenda 40 is a decrease. So that means there was amortization. So the first way, you can just come here direct hapa kwa amortization. And because an amortization, or rather we say equals, and because it is an expense that we want to add back, you simply say,
Mwalimu,
yes.
did you interchange the years? Because mine start with 2021 and then 2022. So my 40s are under 2021.
Hey.
Yeah, I start with 2021, then 2022.
Yours is starting with 2021.
2021.
Okay.
Yeah, so 40 is under 2021.
Yes, there should be an interchange. So if yours here is 2021, make it 2022. The practice, we give the latest year first or the oldest year, the previous year first. What is the practice? Yes, Rachel, we give the latest. Yeah, the current year comes first. The next year comes next. Good, good. So there was a typo in my original paper. I thought I had adjusted in everything. And how comes? Ama niliwatumia from another computer, maybe. But this is how they should be. Hapa weka 2022 na hapa 2021. Just the years. Shaweka hivyo, uteremuke, ni hiyo tu. That's the only place. So I think we are okay. We are okay now.
Yeah.
Good. So if we are okay, So I was saying we began with the 50 and we are ending. Someone is talking.
Yes, Cynthia.
Yes, Cynthia, sema.
Unfortunately or fortunately, I was logged out from the gain of financial asset. Can you repeat from there, please, kindly?
From there?
gain on disposal of financial assets.
Okay. Gain on disposal of financial assets. I don't know what else we have done after that. But what I was saying is this one, we have added a line because we had not included when we were capturing the general. But we are saying that this is not part of our day-to-day activities. And because it was brought as an income, ikaongeza our profits, we must less it. That one. I don't know what else we have done when you are away. My mind has not kept track. Depreciation, nimesema that is an expense that should be put there. Is that okay, Cynthia?
The depreciation is from the additional information.
Yes, additional information number 2 here.
Okay.
Yeah. So I was at the point of saying that this amortization, you can work it directly this way. Useme equals, you start with this one, the opening value. Where is it? This one. You less this one. It comes 10. You can do it that way. Alternatively, you can choose to show the working. You can choose to show the working. If you choose to show the working, you would have something like this. Working 1. Working 1. We can call it amortization. So in this one, we normally begin with the balance brought down. Then we have the balancing figure, amortization, or the impairment, whichever term you can call it. There's no much harm. Amortization. Then balance carried down. So now the balance carried down, unaenda unaichukua hapa hii ya kufunga. This one. The opening, the brought down. Unakuja unaichukua hapa. So this one, you can give it a bottom double. Bottom double. So this figure now will be what I call the balancing figure. The balancing figure. Yeah, the balancing figure here. So the balancing figure then must be equal to this minus this. And then kama umetumia hii approach, sasa utakuja hapa useme this one is equals to this. So either way, whichever you prefer. Whichever you prefer. So with that, we don't have, so the impairment, that one tumemaliza. It's represented by this one. Some people prefer to put them amortization stroke impairment or impairment. We don't have a disposal of subsidiary. We don't have a mention of that. We also don't have a share of the profit of tax in the associate. So those ones now will not help us. So you can either leave it that way, or you can remove the rows that do not have anything. You can remove them. So for me, I can remove, but for you, maybe you can retain so that you have the format. Yeah. But in an exam, you can remove uziache hivyo. So that now sasa ukikuja hapa, tuambie this is equal to the sum. You sum kuanzia hapa. Close the brackets. Aha, enter unitumie jibu, nione unapata ngapi. Press enter. Press enter, send me the figure. One person has given, the others? Yeah, good. Yeah. So this one, you can give it a top border. Top border. Aya. Are we okay at that point? Let's go now to the next working. To the next working. Where now we deal with the inventories. So, or rather with the working capital. So working to working capital. So I will have details here. And my format, obviously, will have the opening balance or the balance brought down. We will have either an increase. An increase will be positive. Increase stroke decrease. Decrease should be negative. According to the way nataka tuiweke. Decrease. We close the brackets. Then we have the balance. The balance carried down. Okay. So let's go and identify in our statement of financial position. Let's go and identify in our financial position statement which items we have. So you add here at current assets. So the first one is inventories. So naweza kuja niweke hapa. Maybe this column naweza isongesha. Maniweke tu hapa. Equals, niweke hii inventory. Kwa wapi, this one. Who else do I have? So I can put my cursor here. Equals. Kwa current assets, I have trade receivables. Who else? So I come here. Niende hapa kwa balance sheet. Current assets, financial assets, those are not taken to be part of working capital. It's not part of our day-to-day activities. Cash and cash equivalent, they are part of working capital, but their change is captured huko chini. Their change is captured huko chini. So the other one that should have appeared here is prepayment. So prepayment is absent. Haya, tukuja hapa kwa current liabilities. The first one is bank overdraft. Bank overdraft is treated as part of cash and cash equivalent because it's not part of, again, day-to-day activities. So hiyo tunaachana nayo. Haya, huyo mwingine ni trade payable. So the trade payables, that is part of working capital. So sasa nikuje, I click this one. Haya. Interest payable is an accrual, but is not part of our day-to-day activities. That is part of financing. So tutaipeleka huko when time comes. Tax the same. Tutaipeleka hapo chini. And that's all. I think that's all. So if that is all, hiyo maneno iko sawa. So let's put the entries. For the inventory, the balance. Inventory, the opening balance is this one. The closing balance equals kwa inventory, this one. Trade receivables, the opening balance. Trade receivables, this one. The closing balance for the receivables. For the payables. The opening balance is this one. And make sure you are picking them the way we are picking, not typing. I told you if a figure is already in existence in an independent cell, you don't type. You go pick it. Yeah. So there we are. So these ones, you can give them a double bottom that way. Alafu sasa hii I hope we are there, all of us. In case umeachwa unasema. So let's just design a formula to say to know the increase or decrease. We shall take this one to be equal to the closing minus the opening. The closing minus the opening. The closing minus the opening. You can as well do the opening minus closing. Then you drag. So I believe we are there. So if we are there, I will come here now. Now this one I can modify. When I look at this one, is this an increase or a decrease as far as inventory is concerned? Inventory, is it an increase or a decrease? This one? Yeah, it's a decrease. Good. So I can come here and now modify. And modify, I say decrease in inventory. Decrease in inventory. Now, when we have a decrease in inventory, is money coming in or going out? When our inventory has reduced, money has come in, is an inflow. Good. So if it's an inflow, we will say equals, and because hapa imetoka ikiwa negative, we then must start with a negative sign so that when we click here and press enter, inaingia hapo ikiwa positive. When inventories decrease, it means you are selling. Umeuza sana, so pesa imeingia. umeuza sana, so money has come in. Haya, look at the receivables. This 8, is it an increase or a decrease? Yeah, it's an increase. Good. So I can come here and say increase in receivables. Now, when receivables increase, is that money coming in or going out? In or out? Two people have responded. The others, where are you? Yeah, when receivables are increasing, it is money going out, because inamaanisha wewe unauza but you are not correcting the money. So now that it is going out, we have to make it a negative. So equals, you make it negative there because hapa imetoka ikiwa positive. So ikikuja hapo inaingia ikiwa negative. Haya. When we look at our receivables, this amount here, is it an increase or a decrease? It's an increase. Good. Is that money going out or in? That money is coming in. So increase in payables. In payables. So the increase in payables, that money is coming in. So tuende tuichukue huku that way. So these others, we can do away with them. We can remove them from our statement. We don't have the prepayments. We don't have the accruals. Tulikuwa tunazitarajia. They are not there. But I said for you, you can retain. There is no harm to know the format. So sasa ikiwa namna hii, unakuja hapa unasema this is equals to the sum of these ones. Close the brackets, press enter, tell me what you're getting. Yeah, 280, good. So this one, you can give it a top border. Higher, good. Let's now go and have a working for the tax paid. That will require a working, the tax paid. So working 3. Tax paid. So tax paid, this is how we go about it. We start with opening balance or balance brought down. You add current tax expense. You get expected tax. Expected tax payable. Expected tax payable. You get the tax paid, or you say now less tax paid, and then you get the closing or the balance. The balance carried down. The balance carried down. Okay. Balance carried down. So let's go for the balance brought down. Balance brought down hapa kwa current liabilities, where we have the income tax payable, ndio hii 34. We can also get there quickly to a carry down. The carry down iko tu hapo hii 19. 19 there. So let's now go for the current tax. Sasa hiyo unaenda kuchukua huko kwa income statement. Seme equals, tuende kwa income statement. We find that it is negative 47. And because tunataka ingie pale ikiwa positive, so you say negative this. So sasa the expected should be, tulifungua na hii hatukulipa last year, tumeongezea hii. So tunafaa kulipa hiyo. You can give it a top border. So hiyo ndio tax that we are supposed to pay at the end of the year. But we are ending with 19. So hatukulipa yote. So if we want the tax paid, then it should be equal to this 81, you less this 19. So this 19, we can give it top double bottom. So this is our balancing figure. That must have been what was paid. Now, if that is what was paid, tunakibia nayo hapa, tunasema equals. Now, there's an inflow. Sorry, is an outflow. Is an outflow. So we put negative this one. Put it there. There. The next thing is this cash from operating activities. Now we combine, we say equals to this plus this. Yeah, that way. Bring it there on its own column. So when we go there now, let's look for now the investing activities. So there is cash received on disposal of PPE. So let's look for whether there was a disposal. So we are told here that there was a plant that was sold during the year, and it had originally cost 40, and it was disposed, and we made a loss of 6. And it had a net book value of 28. It had a net book value of 28. So we need to see what is the loss on disposal. What is the loss on disposal? And what we are going to do, we just come here. Working for. So disposal. I told you the other day when it comes to the disposal of the asset, you can do the format like this. You start with the initial costs, then you say less depreciation recovered, depreciation recovered. Recovered is what we also call the accumulated depreciation. And then we get net book value. Net book value at point of sale. At point of sale or disposal. Then you less cash received on disposal, although si lazima ushinde ukirudia on disposal. When you less cash received on disposal, you are able to know whether you have gotten a gain. Now, penye nimeiweka, when I'm saying less cash, a gain will mean, or a gain will happen if cash is more. If cash is more than our net book value. So, venye nimeiweka, then it means that my gain will be in brackets. My gain will be in brackets or loss on disposal. Yeah. So that is the format that we came across. Sikubuki kwa hiviku, there is a question you are dealing with, FM. So sasa the initial cost, tushaambiwa this asset was bought at 40. That's what they are saying here. Was bought originally at 40. We are also told that they had a net book value of 20. So the net book value, of 28. So this one I can give it a top border. That means the accumulated depreciation must have been this 28 minus this 40. Although that is not necessary. Let me put it the other way around because I've already said ama ikae tu. Ama chanibadilishe someone, not to say that the signs are not correct. Yeah, that way. So sasa, we do not know the cash that was received, but we know, we have been told that there was a loss of 6. There was a loss of 6. This one you can give it a double bottom. So if there was a loss of 6, it means we received less. We received less cash than the net book value. And that now will be given as equals to this 28 minus this 6. So this is the cash we received on disposal. That is the cash we received on disposal. So if that is the cash we received on disposal, tukibie hapa, we put it here. And this is a positive flow, so we just bring it there. We just bring it there. The other thing is, let's see whether there was anything paid to acquire PPE. Now, hapa unakibia haraka, hapa kwa balance sheet or statement of financial position, and you find that the opening balance was 264. The opening balance was 264, and we closed with 327. We closed with 327. So we need to see what could have happened. What could have happened? Now, there are two things that happen, or actually 4. One, you have disposed. Hiyo inapunguza. Number 2, kuna depreciation. Then number 3, you have acquired. That's an increase. And number 4, there is a revaluation. So those things should be in your mind, that they affect the PPE. The disposal, depreciation, acquisition, and revaluation. So the difference between these 327 and 264 we need to find out exactly it was brought out by what. Haya, sasa tukuje hapa tukarabati your working. Working, now we are in working what? Working 5. Working 5. So this working 5, we will call it PPE. Now, as I've said, we will bring the opening or the balance brought down, net book value. Let's work with net book value, the net book value. Then we less any disposal. We less disposal at net book value. Less disposal at net book value. Then we less depreciation, annual depreciation expense or charge, annual depreciation. So then from there, we should have expected net book value. Expected net book value. That is after we have dealt with the decreases, after we have dealt with the decreases. But I've said there is also the other side of revaluations. So we will have revaluation. So you have revaluation, and then we will have acquisition. We'll have acquisition, and then when we get the acquisition, obviously we are adding them. That will give us the balance carried down. And remember, revaluation must not necessarily be a gain. It can also be a loss. You can revalue downwards. You can revalue downwards. Good. So let's now go for that. Balance brought down at net book value for the PPE. Useme equals hapo, alafu tukibie hapa. We have 264. Here hapo. The disposal at net book value. Tulikuwa tumetajiwa hapa. It was mentioned here. And because so far, we already have put it in its independent cell here. Hapa. So tutaileta tu hapo. This one. Bring it there. Depreciation, we already have put it somewhere in an independent cell. I think tulikuwa tumeiweka huku juu hapa. So we bring it there equals this depreciation. So tumeleta hiyo disposal, tukaichukua hapa. Naichukua wapi? Hapa. Then tumeleta hiyo depreciation, tukaichukua hapa. So if those are the only things that happened, that is we disposed and we charged depreciation, then how much should we have had? We are saying it should have been these 264 minus what we sold minus the depreciation charge. So we should have added with 193. So this one you can give it a top border. Give it a top border. But we can see clearly, hata tukikibia hapa tulete balance carried down, we can be able to see that we added with 327. 327. So this one, we will give it a bottom double. Now, acquisition, it has not been mentioned anywhere. But revaluation, we can check whether in the side of equities, equity, kama kulikuwa na revaluation. You can see there is a revaluation reserve here. And what has happened is that we moved from 67 to 36. So is this a gain or a loss? Let me hear from you. Because we have two things that now we need to establish, revaluation and acquisition. Acquisition haijatajwa, so that one we have to get it as a balancing figure. But revaluation, tunaiona. There was a revaluation reserve. Yes, Collins, I can see. Yes, Rachel, it is a loss because we moved from 67 to 36. Sasa hii sababu tumefanya a lot of workings, hii tutaenda tu straight. Tutakuja hapa. Tutakuja tu hapa. But if you want to have a working for it, ni sawa tu. So, for now, tutasema revaluation loss. Revaluation loss, tukuja tuionyeshe hapa, equals revaluation loss. Hii 67 minus hii 36. Sasa, we have the acquisition. Hiyo ndio imebaki. So how will I get the acquisition? So, I hope tutaipata. Hii tukireduce, when we reduce this, it will give us now something less. To give us something less. So how do I get the acquisition? I will have to say equals this 327, I minus this 193, but I add that one. That's all. Are we agree with that? Okay. Yeah. So I hope it's clear. So if it is clear, then we come here. Where were we? We were here at the investments. Sorry, at the finance. Yeah, the investment. The cash acquired, the cash paid. So that should come in as a negative. That should come in as a negative. Now, we do not have a subsidiary. We don't have a subsidiary here. We don't have a subsidiary. So that this one I can remove it. So let me remove. Sasa hiyo nikitoa hiyo line itaniharibia mpaka huku sababu kuna working. Okay. So hiyo nitaachana nayo. Haya. Cash paid to acquire subsidiary, hata hiyo sitatoa, itatoa mpaka hizi. So wacha ikae tu hivyo. Then when I look at my statement of financial position, I can see there was financial assets. There were financial assets. There was financial assets. So this one will require a working because you can see we have opening of 10 and a closing of 22. So we need to see what happened. What happened to that? And you can see there was a revaluation here. This one, can see from 0 to 2. So let's have it as a working, badala ya combine zote pamoja. So now this is working 6. Working 6. So we'll just call it financial assets. Financial assets. So for the financial assets, we will just work the same way like we have done there with the others. So we will say balance brought down. Balance brought down. Then we will get the evaluation. So we'll bring the evaluation. The evaluation. Then we will have the acquisition. And then we will have the balance carried down. So hii tukimbie tuchukue the balance brought down. The balance brought down is this one, financial assets. Revaluation, we can see it is equal to, we will have to show it, don't just pick the 2. It's good to show the examiner, you know, that it is the difference between the closing and the opening. So utasema ni 2 minus this 0. 2 minus that 0. So you bring it there. So acquisition you have to do, but the closing down, we have it. That is where this one. So this one, we are going to give it double. Sasa, this one is a revaluation gain. Actually, we need to be very specific. It's a revaluation gain. It's a revaluation gain. It's a revaluation gain. We need to be a bit specific. So the acquisition must then be equal to this 22 minus what we began with, minus what we added. So we must have paid 10 shillings to acquire that. We must have paid 10 to acquire that. We must have paid 10 to acquire that. So if we paid 10, sasa nitakuja hapa kwa my investing. So huyu nitasema cash paid to acquire. Cash paid to acquire financial assets. Cash paid to acquire financial assets. So it is equal to negative. Kuja hapa. Iweke hapo. Cash paid to acquire the financial assets. So that is all. We don't have anything else. So tukuja hapa. Tuseme this should be equal to this plus this plus this, hata kama hakuna, plus this plus this. Yeah, that's the amount we are getting from investment activities. Getting from investment activities. Let's now go to look at ordinary shares. Ordinary shares, you can see we had begun with what? We began with 150. We are ending with 230. So that is an increase. So if that is an increase, we need to know how did it come about. How did it come about? Okay, my previous solution, I did not let me clear content. No Buddha. So now I am in working 7. Ordinary share capital. Ordinary share capital. Cash paid to acquire financial asset. This one, I've said the cash paid to acquire financial asset. This one, we have gotten it as tulifungua na 10. That was the opening balance. Here, this one. Then there was this revaluation, this one. So 10 plus 2, that is 12. But tunafunga na 22. Instead of closing with 12, tunafunga na 22. So that means we must have acquired. So sasa utasema 22 minus 10 minus 2. Ndio ikatuambia we paid this much. Sasa hii unakimbia nayo unaileta hapa kwa investing. And because it is a money you paid out, inaingia hapa ikiwa negative. So then ukishaweka hivyo, these 4 you combine them and you bring them here. Is that okay, Alice?
Yes, mwalimu.
Good. Haya, let's go to the financing activities, the last one. I hope we'll be able to finish. I don't think we'll finish by 10. So for the ordinary shares, I was saying that when you look at what we had here at the beginning, we had 150 and we are ending with 230. And in most cases, the ordinary shares go hand in hand with the share premium. You can as well see we began with 0, we ended with 30. So the share premium also increased. That means we sold shares at a price higher than the par value. We sold at a price higher than the par value. So we can do independent accounts or we can combine. And I want to combine. So ordinary share capital and premium. And share premium. The concept is the same. They are one the same thing. Actually, the share premium later on will be removed when we do a rights issue or a bonus. So how do we deal with this? Again, the same format. Balance brought down. They had mentioned loan stock. There was a loan stock, this one. So it was converted. So we add loan stock converted. Loan stock converted. Then we have issue of new shares. Issue of new shares. Issue of new shares. And then we have balance. Balance carried down. Yeah, so those are the three. Now these ones are not affected by, we don't redeem ordinary shares. We don't redeem ordinary shares. So we can increase, can only have an increase. And according to the capital maintenance law, we don't again refund the share capital. Yeah. So this one is only affected by issues. And issues is what we have here, loan stock. Loan stock ni wale uko na madeni yao umeshindwa kuwalipa, nawaambia sasa badala ya munidai chukueni hizi shares. Sasa the opening balance, so I can start with the closing because that is where my cursor is. The closing is, tumesema we are combining, so we will say it is this 30, no, 230 plus this 30. That's my closing. That's my closing. My opening is also here. My opening is this 150 plus this 0. Sasa, the loan stock converted, that one is just mentioned here as part of the information. So we will just pick, we'll just pick the figure. Sorry, we will just type, we cannot pick. We'll just pick the figure. So, tulifungua na 150, tuka-convert 50. So we should have added with 200. But we are adding with 260. So that means we must have issued. So the issue must then be this 260. 260 minus what we began with, minus what we converted. That gives us 60. So we must have issued 60. So tukuje hapa cash received on issue. So tukuje tuweke hapa this one. Yeah. So hapa hatuna kina NCI, hatuna HCO. Hatuna, no, we have the finance cost, We have the finance costs. We have the finance costs. So we will have to do a working for it. We'll have to do a working for it. And why we require working, you can see, you see this one, the payable. Yeah, the payable, that will require a working. So, hiyo naweza kuja niweke hapa. That is working 8. I will call it interest. Interest or finance cost. So hii ni kama two tax, It's just like the tax. Actually, I can come. Naona hapa tulikuwa na tax. Ama we just do instead of copying. So balance brought down. Then you add annual interest or the current expense. So the expected expense. The expected expense is what you get there. Then you less what was paid. Less paid. When you get less paid, that gives you the balance carried down. Balance carried down. Balance carried down. So the brought down, tukibia hapa juu, tuichukue. The interest payable, ni hii 3. Current expense, ni ile tulileta hapa juu. Unaweza ichukua hapa, this one, ama uiende huko kwa income. Either. Hapo. So sasa, if we say now these 3 plus this 17, we were supposed to have head. That one you can give it top. Someone is saying mwalimu unaharakisha sana. Mtu anajiongea. Cynthia, ukiona unaachwa unaongea. So where are you? Where are you lost? Cynthia.
Mwalimu, I'm still typing na wewe umeshafika kuweka. Sijaona, so sijaona pale umetoa values.
Mahali nimetoa hii 17 ama mpaka hii 3.
From 3 because I was still typing.
Na hii hata nilifaa kuweka double. So these 3 we are dealing with the interest, so tunakuja hapa kwa interest payable. This one. Naiona hii. Under the current liabilities.
Yes, nimeziona.
So 7 ndio the carried down, 3 ndio brought down, Alafu sasa hii the current unaweza ichukua hapa. Hii 17 hii. Ama uichukue kwenye tulikuwa tushaweka hapa. So that's when nimeichukua. So bring them there, uniambie kama umefika kwa 20. 20 is you add those two. Are we there? Cynthia?
Yes, I'm there.
Good. Haya. So now, we are supposed to have 20. But what do we have? The closing is, the balance carried down is 7. And that 7, you can give it a double. Underline. Hii ni balance. So now we are looking for this one. We are looking for this paid. So kama tulifaa kulipa 20 na tumebaki na 7, kumaanisha tulilipa 20 less 7. Tulilipa 20 less 7. 13. 20 less 7, that is what we paid. So sasa hiyo ndio tutakibia nayo hapa. Finance cost paid, tuseme equals. And because there is a payment, ina lazima ingie ikiwa negative. Negative 13. Ingia hapo ikiwa negative. Ingia hapo ikiwa negative. So interest, they go hand in hand with the dividends. They go hand in hand with the dividends. And how do you check the dividends? You check dividends by looking at the what? The retained profits. So kuja tuangalia hapa retained profits. Naona retained profits, we had an opening of 91, then we closed with 121. Na tulitengeneza ngapi? Tulitengeneza 67. So kama hakukulipwa dividends, if we never paid dividends, we should have this 67 plus this 91. You see, that one is already 178. So sasa, but we have 121. We have 121. So the balancing figure must now be what was paid. must be what was paid as dividends. So let's come here and have a working. Remember, these workings is not a must you write the way I'm writing. You can just pick these figures, you just put the formulas here. You can just put the formulas here. Like now, this way. So now that I don't know who was paid the dividends, I just come here and nitoe hii NCI. I say dividends paid. So if you want to avoid the working, although tutaichora, I will just come here and say equals. Nilifungua na ngapi? Nilifungua na 91. Add. Nikaongeza hii 67. Alafu sasa ninamalizia na this 121. So hiyo ni kumaanisha I must have paid dividends of 37. Yeah. But I want to show it as a working here. I want to show it as a working 9. So what I was saying in the exam, if you are short of time, si lazima uandike hizi workings. You can just go straight, because when we click here, we are able to see your working up here in the formula bar. So you don't have to take a lot of time just for the sake of showing the working. So we are saying this is working 9. And we want to analyze retained earnings. Retained earnings. Retained earnings. That's what we want to analyze. So we will have the balance brought down. The balance brought down. We are supposed to add profit for the year. For the year. Profit for the year. Now, when you add, you should get expected closing balance or expected profit. Then you less dividend paid. Dividend paid, kama kunayo. Dividend paid. Remember, dividends are only payable from profits. So that is the only thing. Otherwise, kama hatujalipa dividends, hiyo pesa inabaki, it goes to investments, or we just hold it as a reserve. So the balance carried down. So sasa tuanzie na hii carried down. Carried down mame hapo kidogo. Give it a double. Already ni saa 4. We have advise me whether we close at that point ama tumalizie. Two or three people to advise. 2 or 3. Okay, we finish. Good. We finish. Good. So with that permission, we proceed. We are not far away. We are not far away. Good. Sasa nimesema the balance carried down iko hapo. So the brought down unaenda unachukua hii tulifungua nayo. This one. Profit for the year. Unaendea obviously profit after tax, not before tax. This one, profit after tax. That one. Profit after tax. That's what we call the profit for the year. So sasa hii useme equals 91 plus this 67. Hiyo ndio profit tulifaa kubaki nayo. Can give it a top border. Hiyo ndio profit tulifaa kubaki nayo, lakini tulibaki na 121. So hiyo ni kumaanisha this 121 you less this 158, kumaanisha tulilipa 37. So you can either show it as a positive or negative, whichever way you want. This language does not necessarily affect. Sasa ikiwa hivyo, sasa nitakibia hapa niseme this is equals to, nichukue tu ikiwa negative hapa, ndio ingia hapo. Kisha ingia hivyo, I think I'm done. I don't have any loan. There was ukiangalia kwa long term liabilities, hatukuwa na bank loan, so it's not affecting us. So with that, we are done with the investing activities. So tukuja hapa tuseme this is equals to this plus this plus this plus this plus this plus this. Hakuna plus ingine, ni hiyo 10. Net cash flow. So net cash flow now, you combine the three cash flows. So utasema ni equals to, wede hii ya kwanza, hii ya operatings, uongeze hii ya investing, na uongeze hii ya where you are getting the money from. So this one, you can give it a top board. So the net cash flow, it's also a major. The net cash flow, I'm saying you add the three cash flows. The one from operating, uongeze the one for investing, na uongeze the one for financing. Now from there, you deal with the cash and cash equivalents. Cash and cash equivalents. Cash equivalent is that which you can easily convert into money. So we come here and give it working 10. Cash and cash equivalent. Cash and cash equivalent. So this one, as you know, we have the details here. Normally bring the details. So the details or the item. The first item that is under cash equals, takibia pale kwa current assets. Naona hapa kwa current assets. Hapa. So under the current assets, you remember when we were looking at the working changes in working capital, tulichukua inventory, tukachukua receivables. But hatukuguza hii financial assets at fair value and this cash and cash equivalent. So, I'll take this. It's one of the items. The next item that should appear there is the actual cash and cash equivalent ata hii. Yule mwingine anastahili kuingia hapo. Ukikuja hapa kwa current liabilities. Current liabilities. Hatujaguza bank overdraft. Wengine tumeguza receipt payables, work on interest payable, work on income tax. Yes. So the bank overdraft. Bank overdraft. So we will have the total. So we will have the values for the year 2022 and the year for the year 2021. So 2022, and remember there was a gain, there was a revaluation. You see this one, this gain at fair value. And did they give us a revaluation for that? No. Okay. The one that we had, this one, we used it when we were computing the financial assets. So kwanza wacha tulete hii opening niko wapi? Current assets. Year 65. Then year 2021, we are supposed to bring this 30. This one. And then we add this revaluation gain here. This revaluation gain on financial assets, this one. Because we have not captured it elsewhere. So we add it there. Then, tukuja kwa cash and cash equivalent. Cash and cash equivalent for the year 2021. Cash and cash equivalent is 0. Then cash and cash equivalent for the year 2022. For the year 2022 is 29. Higher bank overdraft for the year 2022. For the year 2022 is 0. But for the year 2021, there was an overdraft. Now, this overdraft comes in as a negative because ni pesa tulichukua. So pesa yetu ikiingia wanangoa haraka. So it should come in as a negative. So if it is coming in as a negative, then down here, I will just say equals this plus this plus this equals. Yeah, it should be captured from the value of 2021. The value of 2021, Rachel, that gain.
Okay.
Because that's where we began the year. So remember 2022, we are giving us at the end, eh? Yeah.
Yes. Okay.
So this one, if I just drag here, and then I can give them double. So sasa hii, we will add the opening. So the opening ni hii, this one. So when we add, I should now say this 81 plus this 13. And this one I give it, and they should balance. This 94 should agree with this one. Good. Any question? So if we are satisfied, make sure we may revise how to do cash flow. How to do cash flow. So that in case wakulete, you'll be able to find your way out. Good. So we then call it a lesson at that point. And I think we are done with this paper now. So I will send you, in course of time, I will send you the next paper that we shall handle in our next lesson. Good night.